Perfect. Well, I'm Jared Havens. I'm with Prosper Law Group. We have something within Prosper Law Group that we call Credit Life 101. And really what it is just education surrounding credit and financial stability. So in today's course, Jeremy and I, that's going to be the focus on what we're going through when it comes to credit improvement strategies, credit building strategies, credit repair strategies. So if you have had any issues in the past, what you need to be aware of and how you kind of tackle that to get, moving forward and be successful. But as well as budgeting. Financial success, a big part of it is going to be through credit. Credit leads to lower interest rates. It leads to lower insurance premiums. So by having good credit, it's going to lead to, easier financial success. But when it comes to budgeting, that's really key too. It's understanding what's coming in and what's going out. So that way, if you guys know you have any specific goals in the future, you can really nail down understanding, hey, where am I at financially? What are the things I need to do to set myself up to be prepared to hit these goals moving forward, lending related goals.
Right.
Jeremy?
I'm Jeremy Dysock. I am also part of Prosper Law, Credit Life Group there. I've got about 22 years of credit and banking experience. I've worked in every aspect of banking, from opening a savings account to doing a $100 million line of credit, everything in between. I'm former CEO of National Independence Mortgage Corporation. It's a company I founded and sold back in November of '04 before the market crash. I've since joined up with Jared, and we were helping people with their credit. One thing to know, Jared and I are both FICO certified. Has anyone heard the term FICO score before? Do you know what a FICO score is? FICO scores, essentially it's a name brand of scoring model. It's kind of a filter for data. There are 3 credit bureaus out there. There's Equifax, there's Experian, and there's TransUnion. And they keep data on you guys, on me, on them, on 350 million people. And they get data in from all these different sources. And there's got to be a way to take a look at this data and turn it into something simple enough to tell a story. And FICO is what does that. So it interprets the data and comes up with a FICO score. A FICO score, quite simply put, it's a risk rating. How risky are you to lend money to? The higher your FICO score, the less risk you are. The lower your FICO score, the more risk you are. FICO is the model that's used by about 90% of lending institutions throughout the United States, and that's why we focus on it so much. So, starting off in the beginning, credit. What is credit? Credit itself is an arrangement that allows consumers to buy goods or get services now and pay for them later. So if you use a credit card, for example, to charge purchases, you may be subject to a finance charge as you pay it later. You may be subject to interest as you continue to pay it later. The whole purpose behind credit is most of us don't have pockets full of $100 bills that are going to allow us to walk into a real estate transaction and say, hey, yeah, I like that house. Here's my $150,000. Because that's not a realistic thing to do, there has to be a way to have these transactions happen, and that's through credit. You get to use the service. You get to live in the house while you pay it back, okay? So there's a reason that good credit is important. Does everyone agree good credit's important? Okay. There's a reason that good credit's important. Credit's utilized in almost everything you touch these days. Home loans, mortgages, automobile loans, student loans, credit cards, rental background checks, employment background checks, utilities, car insurance. Did you know that the lower your credit score, the higher your car insurance rate will be? That's true.
And that's also, as well to touch in on that, not only auto insurance, life insurance, as well as mortgage insurance. So, and the reason why that is, just to give a background on that, is there were studies, because a lot of people when they hear that, they go, why would I pay more? My credit has nothing to do with my driving record. Well, the reason why that is because there's been studies that show that people that had a tendency to have credit issues on their report had more often that they would actually file claims to their insurance, and on top of that, the claim amounts were higher. So what insurance companies decided to do was, okay, we're going to take a look at the credit history to then evaluate, should we charge this person more to insure them? So that's another reason why having a good credit score and a good credit history is so important, which then obviously leads to better financial stability in your future.
So credit touches every aspect of our life. Can you get a job? Can you get a place to live? Can you get a set of wheels? Can you insure that set of wheels? Can you pay for school? It's a very, very, very important, and as you guys agreed, important part. You may not have realized just how important. So there are advantages to using credit, obviously. Number one, you get to use the goods and services as you pay for them. You get to drive the car before it's fully paid off. You don't have to wait 5 years to finally get your 2016 car in the year 2021 because you finally made your last payment. Instead, they say, here you go, make these payments back to us. It gives you the opportunity to buy costly things that you may not be able to buy otherwise with cash. For example, can you imagine paying cash for a brand new car? How about a house? How about college out of the pocket? That's a heck of a thing, right?
Especially nowadays.
Yeah. Credit can also be a little bit of a safety net. It can be a source of cash for emergencies or unexpected expenses. Oh no, the brakes went on in the car. It's gonna be $850 and I've got just enough money for ramen till payday, right? So, medical, automotive, these are things that can save you in a pinch. And then convenience. Let's face it, credit can be convenient. Travel, you don't have to carry large amounts of cash with you. There's a safety, there's a convenience to it. Maybe you rent a car and they want a big deposit. Well, you put it on the credit card so you don't have to part with your money and you can still spend it at Disney, right? So there are a lot of different advantages to using credit itself. Now, with that, there are also disadvantages of credit. One disadvantage of credit is reduction of future income. Reduction of future income. Has anyone ever heard of a bankruptcy? Has anyone ever known anybody who got in trouble and couldn't pay their credit card bills? Has anyone ever known anybody who spent more than they could afford to? Credit can allow you to do that. So it's something you want to be cognizant of and pay attention to. It's something you want to be aware of. So you don't want to spend your future income now and live beyond your income, okay? Another disadvantage of using credit is expense. Using credit costs money, fees, interest, finance charges, additional money for the item that you bought. You're paying for the convenience of that car right now, and you're paying it in interest. Temptation. I can resist anything except temptation, right? It's really painfully easy to justify using your credit card. Here's what you're going to do. You're going to have your credit card in your hand. You're going to look at that shiny blinky thing and go, you know what? I'm going to buy that now. I got a big check coming up in 2 weeks. I'm going to buy that. And what I'll do is I'll pay it off before it's due. And guess what? No, you won't. Nobody ever has. So temptation. It's really easy to spend the money that you don't or won't have. And then the risk of serious consequences if you misuse credit. There are consequences. Failure to pay your debts on time if you get overextended. Bankruptcies, saying, hey, I can't do it anymore. I gotta wipe this thing off. Repossession, that's when you go to bed with a car in your driveway and you wake up and there doesn't appear to be a car in your driveway anymore. And also a damaged credit score, which we all know now affects everything. It affects your insurance rates, it affects everything. So the disadvantage is you can hurt your credit score that then becomes extremely expensive for everything else in your life. So it can snowball up on you, okay? Now, there are different types of consumer credit. You guys are consumers, we're consumers. We consume, we buy things, we use things. The different types of consumer credit are sales credit and cash credit. Sales credit and cash credit. Sales credit is this. If you buy goods and services with a credit card or a charge account, you're using sales credit. You're using the money right there on the spot, the credit's being issued for the object. Essentially, a mortgage is technically sales credit. A car loan is sales credit. And then there's cash credit. Cash credit is when you flat out borrow money, it's loans. So the difference is the bank's making the check to you instead of Ford. The bank's making the check to you instead of Wells Fargo. Okay? So, cash credit and sales credit. Now, within sales credit, you find credit cards. Who's got credit cards? Who's ever had credit cards? There are lots of different types of credit cards out there, lots of different types of cards. There are travel and entertainment cards. Those are cards where you have to pay the whole bill each and every month except for travel-related expenses. A lot of these things have no credit limit. That's nice and safe, right? Monthly payments, around 18% APR on, 18% interest on travel-related expenses. And a good example of that is the old-fashioned American Express, where you have to pay it off right after you charge it, right? But they'll give you, sky's the limit. I mean, if your credit's good enough, you could buy a Lamborghini on the thing. Problem is, you gotta pay for the Lamborghini. The other types of credit cards, company or retail store cards. These are cards that permit you to use the card only at their place. You cannot go to JCPenney's with a Macy's card. You can physically bring it, but you can't spend your JCPenney's card at Macy's. You can't spend on your Macy's card at JCPenney's. They are store specific. They've got a credit limit. They've got minimum monthly payments. The interest rate varies. And then there's general purpose cards, or what are called bank cards. These are issued by banks, and they can be used darn near anywhere. They've got credit limits, they've got minimum monthly payments, and the rates can vary wildly. Some have rewards and cash back and things like that. Examples, we've heard of them: Visa, MasterCard, American Express Consumer, and the Discover card. Okay? So those are your bank cards. You can use them darn near anywhere. So there's three types of credit cards. Are any better than the other? Really, at the end of the day, no. They're all considered revolving. Revolving credit. Revolving credit. You can charge it up, you can pay it down, you can pay it off, and as long as you're happy with the bank and they're happy with you, you guys can keep revolving that forever. Okay? That's revolving credit. Now, is there a preferred type? Well, wouldn't it make sense to have one you can use everywhere versus one that you can only use one place? So there is a method to the madness. Now, with credit cards, with borrowing like that, you will have something called a finance charge. Does anyone know what a finance charge is?
You don't pay it all off.
Okay.
They charge you
Right.
a fee.
Correct. What it is, it's the total amount you have to pay for using the credit. So if we go to TGI Fridays and we get a soda and we get a burger and we spend $15, we throw it on our credit card and we make little payments on it until it's paid off, that burger may have cost us $20. Your finance charge is $5. So it must be a very good burger. Right? Because you spend an extra $5 on that burger. That'd be for get up and sing and have sparklers and stuff like that. So finance charges are the amount of money you pay over and above the service or the thing you got, right? And there's three factors, three different things that are going to affect your finance charge. One, the amount of credit you use. The more you charge, the more money of it's going to go away in interest, right? You're going to spend more money in interest. The interest on a $100,000 loan is a lot different than the interest on a $1,000 loan when it comes to dollars and cents. Annual percentage rate. The higher the interest rate, the more finance charge you're going to pay. The higher the rate, the more borrowing money costs you. And then the length of the repayment time. The more time you take to repay something, the more finance charge you are going to incur. So if you go to Best Buy, you buy a flat screen TV today for $500, and even though it might have a super high interest rate on that credit card, that Best Buy card, if you pay it off within 2 months, you're not paying much interest. You're not. But if you do the minimum payments and eventually pay it off at the end of 2 years, 3 years, you're going to have paid interest every single month for all those years. That adds up. You'll have paid a lot for that flat screen. But you have to weigh what the exchange is. The exchange is that you were able to use it that entire time you were repaying. So it allows us to get bigger things that we may not have been able to get otherwise when we're paying for them. Does that make sense? Any questions so far? Good?
Can you talk
Yeah.
about debit cards too?
Debit cards, you're spending your own money. It's your money, you're spending it, and that's it. It's a plastic version of a check, basically.
Does that impact the credit score?
It does not. Yeah, a debit card is tied to your checking account. Banks can be kind of funky sometimes, okay? A lot of times they'll want to look at your credit when they're starting up with you. And boy, will they report to credit if something goes wrong. But when it comes to like your checking account and your debit card usage, they don't report that day-to-day usage. Utilities can be the same way. Comcast, they're gonna pull your credit. CenturyLink's gonna pull your credit. T-Mobile, getting the cell phone's gonna pull your credit to open something up and decide what type of phone you're getting and what type of plan you're getting. But then they don't report your on-time monthly payments. But boy, if you mess up, they'll be perfectly happy to report that to credit.
Can you ask them to report it if you pay religiously?
Yeah, but they won't.
Yeah.
You can say, can you please do it? They'll say no, and okay, thank you for, I just might ask.
You know, that's important to understand too, as well as the debit card piece, is that your income and your assets do not impact your credit at all. You know what I mean? So they don't directly correlate to your credit score. So that's important to know, because a lot of people don't know that. You know, they kind of automatically assume in a way that, hey, my income, I make X, you know, I can afford these things, I should have good credit. You know, it's almost like a common sense type thing.
Yep.
But one thing you have to keep in mind about credit, as we're learning here today, you almost have to throw common sense out the window.
It is.
You know, because the way it's all about risk. You know,
Right.
FICO's role is to evaluate risk. And when we're talking today about credit and lending, it's to help lenders make better lending decisions. That's what it's used for. You know, so they're taking a look at your history. And when we get into more about the credit bureaus, Equifax, Experian, and TransUnion, those are the three major credit bureaus, and they're responsible for taking in the data, furnishing that data, and they sell that for a fee.
You say major, are there more?
There are other credit reporting agencies, yes. There's Check Systems, that's for banking. There's smaller ones actually. There's some that report for public records. So if you, let's say you got into trouble and you had an account go to judgment, it's not necessarily that they're directly reporting to the bureaus. There's a third party credit reporting agency that's then reporting that information to the major credit bureaus. So there's a lot of companies, and one thing you got to keep in mind, they're all for-profit companies.
Yes.
Equifax, Experian, TransUnion, Nike, Reebok, Adidas. That's what it is. Large corporations, they make money in our data. So interesting thing that you guys can take a look at too, if you ever apply for a mortgage loan and you see your credit report, in the upper right, you're going to see the cost of pulling that report. It costs money to pull that data every time. So that's one key thing to understand about the credit reporting agencies, and then FICO's separate, and their role is to evaluate that data to then issue that score.
They're the filter.
Yep.
They filter the data and provide a result. But the credit bureaus, Equifax, Experian, and TransUnion, they are mercenaries, they're not missionaries. They're in it for the money. So, how do we establish credit? Or, if we've had credit issues, how do we reestablish credit? Establishing credit, there are 4 main steps and a 5th kind of secret little step to building a sound credit reputation. And my guess is this is the part you guys are here for. Number one step in building a good credit reputation is start with a job. Show the ability and willingness to repay in a timely fashion. Any of you ever go right after high school and get offered a credit card, or in college given a credit card before you had a job? Yeah, that's great. That's a heck of a thing. Yeah.
Yep.
They wondered why I didn't pay. I said, why are you wondering? I said 0 for my income. They gave me a $300 credit card, then wondered why I didn't pay. I was young and dumb.
Yeah. And this plays into what this class is all about, is making sure that you're making sound decisions. You know, so if you are applying for credit, you need to understand that you have the ability to then repay them.
Correct.
Because you don't want to put yourself in a position that you overextend yourself and over leverage yourself with credit. That's when issues happen.
Right.
You know, credit cards start to get maxed out. Interest rates start to increase. You go over the credit limit. All those things are high risk. And then it puts you in a bad position where now your minimum payments, just to stay current with the card, you can't even afford that on top of your other bills. You know, so these are all things that you just have to, and when we talk about budgeting later, that's what we're going into, is just understanding how do I make those better decisions? How do I change my spending behavior?
So we want to show that you can hold a job and that you can earn some money. Second step, open 2 small credit cards, revolving credit. Open 2 small credit cards. I don't mean physically small, I mean limits, right? Open 2 small credit cards and use them. You have to use them. There will not be anything getting reported if you are not causing activity. We need activity to generate points, okay? So you want to, how do we use them? You want to make small purchases and pay your bill on time. Make small purchases and pay your bill on time. And I'm not talking about a $300 limit credit card, spending limit, and maybe be buying $100. I'm talking about a $300 limit credit card and spending between $3 and $9, which you'll work out is 1 to 3% of the limit. There's a reason you're going to hear us hammer on 1 to 3% of the limit. Good side note for my tangent. You guys have been told things your whole life on how to use credit cards. I was talking to bankers about this and they're going, wow, right? You've been told, keep your cards under half. Don't spend more than half. People like to tell people that. People will say, well, keep your cards under 30%. People are just married to that number. Keep them under 30%. Some people say, use your credit card to pay them off completely every month. You know, charge them off, pay them down. And other people say, open them and don't use them. Have you ever heard one of those? Ever hear two of those? Three of them? You ever hear like all those? Right, well then God bless them, they're all wrong. Those are four completely conflicting answers. And these, you're hearing this from bankers and teachers, realtors and parents, the car guy, the mortgage guy, Susie frickin' Orman on TV.
Where I get my stuff from.
And she's wrong. She's wrong. God bless her, she's wrong. What these people are trying to talk about, and don't think they're doing it for bad reason, they all have really good intent. They want to help you. That is why they're trying to educate you on this stuff. The thing is, they just don't know. They've been taught it by people who are taught it by people who are taught it by people who are taught it from someone who either didn't want to sound stupid and gave an answer or thought they knew how it worked. Okay? I'm FICO certified. I'm certified in the algorithm, the mathematics and formula that make the FICO score. Jared is as well. There is a perfect balance to limit ratio in the FICO algorithm. It's perfect because it's the zone, it's the region, it's the usage that'll add the most points to your score each and every month. And it's comically small. It's 1% to 3%. That's it, of the limit. 1% to 3%. So if you have a $300 limit credit card, $3 to $9. Any more you broke it, any less you broke it. Any less you broke it because less than 1% is not considered activity. And we need activity to generate points. Yes?
And so you should carry that 1 to 3% every month?
When the card reports, you want to have that on there.
Okay.
Any more than 3%, you broke it because you did not listen to Jeremy. And you went outside the zone. You went outside the region. Okay? The thing is now we know this. We can work with this. Who's got Netflix? How much is Netflix? About $8.56 for the 2-screen one?
Like, yeah.
So you put Netflix on your $300 limit credit card that you've opened. You set your checking account when the bill is due to automatically pay the credit card. Then you cut the credit card out. Money goes on, money gets paid. Money goes on, money gets paid. What do you have to do? Nothing. Watch movies. Here's what's happening. It sounds painfully simple. It's because it is painfully simple, but what it's doing is complex. Every month starts off, there's nothing on the card, suddenly, bam, Netflix hits, that's activity. We get points for activity. How many points are you going to get? I don't know. How much is our activity? It's 1 to 3%. So you'll get the most possible points in the FICO algorithm. That money stays on the card until the bill is due. That creates, as they call in FICO, a trended average daily balance. You get points for a trended average daily balance. How many points are you going to get? I don't know. What's our trend? Oh, it's 1 to 3%. You're going to get the most possible points. The bill becomes due, checking swoops in, boom, it pays it. Showing, as I believe they may still say in banking, we used to, the ability and willingness to repay in a timely fashion. And you get points for that too. And then it happens again. Activity, average daily balance, payment, activity, average daily balance, payment, points. What do you have to do? Nothing. Watch Orange is the New Black.
One thing to keep in mind too, when he's talking about this, this is really key. It really is. So for anyone in here right now, if you guys are interested in how to maximize your credit score improvement potential, you want to do that. You know, and here's another thing. Don't mistake that's truly to maximize your potential. Now, if there's a hardship, if something happens, if you have, you know, your car goes out, you need to get it fixed. That's another reason why credit cards are there, to help you with those type of circumstances, to be prepared for it, so that we can use it. But then you want to always make sure that you work on paying that back down to that ratio. And one thing too, I write this down, because a lot of people don't know this. When a lot of people don't understand how information is reported to the bureaus, okay? So when you have credit cards, take a look at the statement. You're going to see a statement closing date. That is the date that they reported the information to the bureaus. So when you hear 1 to 3%, some people get confused because it really is. It sounds simple, but it is somewhat complex. And people forget, and they leave and they go, "Oh, you know what? Yeah, I wanted to buy this. I know I want it 1 to 3. I'm going to buy this for $100, and then I'm going to pay it down to 1 to 3%." You only want to charge 1 to 3% period in the course of that month, because then when it hits that statement closing date, that's the information that then gets reported to the bureaus. That's how it shows up on your credit report. It wasn't the payment itself. Because remember, the statement closing date is not the bill due date. There's a difference.
Essentially what he's saying is, when they send you a bill, they've already reported,
Yep.
before you ever had a chance
Yep.
to make the payment that they're, on the balance that they're reporting about.
And this is like later on when we talk about for anyone that has credit card debt and they have higher ratios, that's very important to understand, to take a look at your statement closing date so you can time your payments on strategic debt reduction. And another thing that we'll go over later is understanding that how long they've been established, because length of credit history also impacts your score. So if you focus on paying down cards that have been open longer, that will positively impact your credit scores even faster. You know, so these are some things that we'll be able to talk about if you have credit card debt and how to pay them down.
Yes.
Are the credit cards that are sort of protected by the banks where you put a down payment down and
That'd be a
those
secured
card?
credit card. Yeah, we can go into that a little bit.
Yep.
you get the same benefits?
Actually, I'll do it right now. Yeah, secured credit card. What you're doing is you walk into the bank and say, "Hey, I want a $300 secured credit card," and they go, "Great, give me $300." You give them $300, and they put it in a small savings account that you do not get to touch. And then they give you a credit card, and the credit card they give you is a normal credit card.
Yep.
It's got interest, it's got payments, you pay it on time, that was good, you pay it late, that was kind of dumb. Charge it up, pay it down, pay it off, use it again, as long as you're happy with the bank, bank's happy with you, it'll keep, remember, revolving forever. A lot of times what the banks will do too is about a year down the road, a lot of them will review your credit. And if you've played nice in the sandbox and done what you're supposed to do, they'll often refund you your $300.
Yep.
Even raise your available limit, and you get to keep the card. Now it's unsecured. That's a way to develop credit when your credit in the beginning is quite so good.
That's a great option for building. What was
If
that?
you're late on a payment, do they use that $300 to pay it on time?
No, they'll give you a late
No.
payment fee.
Yep.
Here's the thing:
Once-
if you charge up the $300 and skip town to Tijuana,
Yeah.
they got the $300 back.
Yeah.
Yeah.
It still reports and is treated like a credit card.
With
That unsecured, or the secured credit
It's-
card turning into an unsecured.
It's okay.
U.S. Bank 6 months. Most of the other banks I've seen 12. Your mileage may vary.
And what you were saying there is that the whole point of a secured credit card, it's really tailored towards people who have had issues and they now have poor credit, or they don't have any credit and they need to build credit. That's really what it's for. So what you're doing to help eliminate the risk for the lender, you're securing it with your own funds.
So security for them, not for me.
Exactly.
Yes.
That's
It's
exactly.
their
what it
insurance
is.
policy. You become significantly less risky.
That's good. There we
Your
go.
processing is spot on.
Yeah.
Okay.
All right, so we're establishing credit. We started off by,
Okay.
oh, I'm sorry, yes.
My question was, so when is a good time to pay the credit card? The
That's-
due date or before?
That's a great question. If you're within those ratios that we're talking about, 1 to 3%, pay it on the due date.
Correct.
Now, if you're working on paying ratios or wanting to bring ratios down, you'd want to try to do that before the statement closing date.
Right.
Yep.
Because they'll always report
So
a little bit better.
here's an example. Car breaks down, right? I need new brakes. I need something. I don't have the cash right now to do it, but I do know, like you said, if you're going to do this, actually do it. But hey, I'm going to use this right now so I can take care of this because I got to drive, I got to work. But then I also know that I do have the ability in the course of this month to pay that down. So as long as you use those funds then to pay it down before the statement closing date, it's gonna report it how you want it to report, so you're being proactive in maximizing your credit score improvement.
So how many days before, like, you pay, so,
Good rule of thumb, we always tell people 3 to 5 days prior
Yep.
to the billing cycle
Yep.
closing of the statement
So
date,
it
just
goes
because
through.
credit card companies take time to process.
Yep, yep.
All right, so we've started off, we've demonstrated an income. We've opened a couple meaning at least 2 revolving credit cards, made small purchases. We also want to have an installment loan. Installment is the opposite of revolving. Installment loans are loans in which you make equal monthly payments until the loan, is paid off. And once it's paid off, it's over, that's it. These are car loans, student loans, and things like that. You know, you can't pay off your car loan with Ford, and once it's paid off, go back to Ford and say, hey, can I have $800 more now to buy a microwave? They'll say, no, you're crazy. I think you're looking for a credit card, okay? So you want to open up an installment loan. The reason this is balance of accounts. This is having a blend of accounts. That's important to show you can handle, that you can demonstrate many different lending scenarios, and that'll benefit your score. Now, if you are not wanting to, or if you are not in the position to, or if you're not in need of running out this afternoon and going, okay, they said get an installment loan, and buying a car or enrolling in college, that's okay. There are a number of banks that offer a specific credit builder loan. Probably the best one we have found without question in the Twin Cities is Guarantee Bank. They used to be in Rainbow Foods. They're in a bunch of the Walmarts. They're in Red Lion, they're over by Quarry. They're in Red Lion over in Brooklyn Park. Guarantee Bank, it's one of those little in-store banks. They've got something called a Credit Builder CD. It's a Credit Builder savings account. Here is how it works. You walk in there and you say, I want to open the Guarantee Bank Credit Builder CD. They say, hey, great, give me $22.25. And next month you give them $22.25. The month after, you're going to give them $22.25. And you guys are noticing the pattern, right? I don't have to say it 60 times. All right. You're going to do that for 60 months, 5 years. Every month, $22.25. They've been putting this money towards a savings account for you, called a certificate of deposit. At the end of that, you've tucked $1,000 away for a rainy day. When the 5 years is up, you get the money, which is cool. And it's good to have savings. But that's not why I want you to do this. When you walked up to them and said, I want to open this account, they made you a loan. They made you a loan for $1,000, and you signed for the loan. And they took the $1,000 from the loan, and instead of giving it to you, they kind of gave it to you,